We're jumping straight into Armlogi Holding today. Everyone is watching the price action, but the real story is their massive logistics footprint combined with a debt-free balance sheet.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Make sure you subscribe and hit the like button so we can keep simplifying these market moves for you.
Yeah, please do. It really helps us out.
Right. And just to set the stage for you guys right out of the gate, today is Saturday, February 28th, 2026.
Hard to believe we're almost through February already.
I know, it's flying by, but the company's just released their fiscal 2026 Q2 results a couple weeks ago. That was on February 14th.
Yeah, dropping earnings on Valentine's Day.
Right, romantic stuff. And our mission for you today is really to make sense of this situation, because we're looking at a highly volatile, low-float logistics stock here.
Which is always a wild ride.
Yeah, it is. And it's suddenly popping up everywhere on the radar of active traders. So we want to cut through all that intraday noise and look at the actual structural tension happening behind the scenes.
Yeah, and there is a lot of tension there. I mean, when you're tracking a low-float setup like this in the industrial sector, you're usually dealing with a pretty binary narrative.
Meaning it goes one way or the completely opposite way.
Exactly. It's like either the physical asset base they have acts as this massive coiled spring for the share price when the volume finally arrives.
Right.
Or the fixed costs of maintaining all that infrastructure just slowly bleed the equity to absolute zero.
It's a high-stakes game.
It really is. Traders are currently trying to aggressively front-run the answer to that exact question, which is why we are seeing such explosive price action over these last few trading sessions.
So to really grasp the stakes of that binary outcome, we have to look closely at the moat they've attempted to build.
Let's break that down even further.
Yeah, because we're talking about heavy, boots-on-the-ground infrastructure here. It's not just software. They currently operate 11 U.S. locations.
11.
Controlling over 3.5 million square feet of ISO 9001 certified warehouse space.
And you really have to visualize that scale for a second.
Yeah.
That 3.5 million square feet isn't just standard pallet racking for, consumer electronics or T-shirts.
Right, small parcel stuff.
Exactly. They have strategically carved out this niche that is entirely focused on large and bulky items.
Which changes the game completely.
Oh, completely. It is arguably the most difficult segment of the logistics market to operate in. But, and this is the key, it's also the most defensible once you actually establish a foothold.
Because it's just so hard to do.
Yeah. Moving customized furniture, industrial machinery, oversized home goods, it introduces massive friction into the supply chain. You can't just slap a shipping label on a heavy sofa and throw it on a standard automated conveyor belt.
Right, the belt would just break.
Exactly. It requires specialized material handling equipment, distinct dock door configurations, and a completely different algorithmic approach to just figuring out the spatial dimensioning in the warehouse.
Spatial dimensioning. Meaning just how to physically fit weirdly shaped heavy things into a massive room efficiently.
Precisely. And the broader third-party logistics market is incredibly fragmented because the barrier to entry for small parcel fulfillment is so incredibly low.
Anyone can rent a small space and ship phone cases.
Right. But in the bulky goods sector, the capital expenditure and the deep expertise required, it acts as a severe deterrent to any new entrants.
And it's not just the storage either. They have paired that bulky goods storage with true end-to-end integration.
Which is huge.
Right, because they handle the customs brokerage at the port, they do the drayage and the trucking, the actual fulfillment, and even value-added services.
Like kitting and repackaging.
Exactly. So when you lock a large-scale furniture retailer, for example, into that kind of fully integrated end-to-end system, the switching costs become just astronomical.
Yeah, the stickiness of that client base is really the absolute core of the bull thesis here.
Right.
If you are an enterprise client and you're fully integrated via API into their warehouse systems and you're relying on them to clear your heavy goods through customs and manage your final mile staging,
You're not leaving.
you do not simply rip out all of that infrastructure just to save a fraction of a cent per cubic foot with some local regional competitor.
It would be a nightmare.
It would. The operational disruption of moving millions of dollars of bulky inventory physically across the country to a new provider would destroy your own quarterly margins.
So that niche dominance provides this highly durable revenue floor. It theoretically insulates them from the aggressive pricing wars that we constantly see in the small parcel space.
Exactly.
But, while the physical scale on those high switching costs are impressive, The financial structure underpinning the whole operation is the real anomaly here.
It's the craziest part of the story.
It really is.
Yeah.
Because you would expect a company maintaining 11 massive facilities and executing capital-intensive heavy logistics to just be levered to the hilt.
Drowning in debt.
Right. Yet the most striking metric on their entire balance sheet is a 0% debt-to-equity ratio.
Zero debt in a notoriously cyclical, capital-intensive industry is almost a statistical area. It just doesn't happen.
They have absolutely no leverage burden. None.
Which is wild.
And when you factor in the current cost of capital here in 2026, operating without the heavy anchor of institutional interest payments gives them a massive strategic runway.
The lack of leverage completely alters their survival timeline. In logistics, demand ebbs and flows violently with broader macroeconomic cycles.
We've seen that over the last few years.
We have. Highly levered competitors are routinely forced into restructuring or distressed asset sales the second supply chain volumes contract, simply because they miss a covenant on their debt facilities.
They just can't make the payments.
Right. But by maintaining a zero debt profile, Armlogi has effectively insulated themselves from those credit market shocks. They can absorb industry downturns without the immediate existential threat of insolvency hanging over their heads.
And part of that capital discipline really stems from their remarkably lean operational structure. Because despite managing 3.5 million square feet, they are running a core team of only 200 employees.
That ratio is staggering.
It is. We have to assume they are leaning heavily into automation, aggressive third-party labor contracting, and the capital preserved from their IPO back in May 2024.
When they debuted at $5 a share.
Exactly. They're using that to maintain that pristine debt-free status.
But, managing that kind of square footage with a headcount of just 200 points directly to their reliance on their proprietary technology, you cannot physically run 11 facilities across the U.S. handling irregular, bulky inventory with a lean team like that unless the software architecture is doing the heavy lifting.
Which brings us to the Armlogi OMS, their order management system. And this isn't just an off-the-shelf inventory tracker. It is the digital nervous system designed specifically to extract operating leverage out of that massive physical footprint.
The OMS handles the spatial inventory management, the predictive sales forecasting, and the really complex routing for order fulfillment.
Because when you're dealing with oversized goods, inefficient routing or poor spatial placement within the warehouse just absolute destroys margin.
Yeah, think about it. If a forklift operator has to move 3 heavy pallets out of the way just to access the one that actually needs to ship today, the labor cost for that single order skyrockets immediately.
The OMS is essentially their primary tool for cost optimization. The physical warehouses provide the raw capacity, but the proprietary software is the only mechanism they have to turn that fixed cost capacity into scalable profitability.
Exactly. If the software can accurately forecast volume and optimize the placement of high-velocity, bulky items right near the dock doors, the turnaround potential for their operational efficiency changes drastically.
And there are signs in the SEC filings that the institutional side of the market is actually paying attention to this infrastructure tech combination. If you look at the Schedule 13G filings from July 9th, 2025, there is a clear footprint of potential institutional accumulation.
And that presence of 13G filings is a critical breadcrumb for you to monitor. Institutions do not typically park capital in volatile, low-float logistics names without a highly specific long-term thesis.
They're not just day trading it.
No, they're likely looking past the immediate quarter-to-quarter noise and focusing heavily on the underlying value of that debt-free 3.5 million square feet and the stickiness of the client base. They see an asset play or a turnaround play that the broader retail market is currently completely ignoring.
And we might actually be seeing the first faint signals of that turnaround in their recent fiscal 2026 Q2 earnings, the ones released on February 14th. They actually posted a revenue uptick of 0.8%.
It is a razor-thin margin of growth.
True, very thin. But in a macroeconomic environment still navigating the tail end of supply chain normalization, a shift from contraction to even fractional growth is a vital data point. It signals a potential stabilization in e-commerce demand for heavy goods.
Looking at the flip side.
Yeah, we have to address the absolute carnage in their profitability metrics.
We do.
Because the zero debt and the massive footprint sound bulletproof, but the trailing 12-month gross margin is sitting at a devastating negative 2.67%.
Ouch.
And the net profit margin is bleeding out at negative 9.81%.
Yeah, a negative gross margin is the ultimate red flag in this sector. It indicates that the fundamental unit economics of their core business are just upside down.
I mean, they're losing money on the actual service they provide.
Exactly. It means the direct cost of servicing their clients, the labor, the immediate facility upkeep, the operational execution, all of that exceeds the actual revenue they collect for those services.
Wow.
They are effectively paying a premium just to move their clients' inventory. And that's before you even factor in administrative overhead, marketing, or any of that tech development for the OMS.
Which really cast a very long shadow over that 0.8% revenue growth we just highlighted.
It entirely changes the context of that growth. When you factor in the baseline inflation of operational costs, a 0.8% increase in top-line revenue might actually represent a contraction in real volume.
That makes sense.
And this exposes the fatal flaw in operating 3.5 million square feet of warehouse space. The fixed costs are brutal and unforgiving.
Because you pay the lease, the property taxes, the baseline utilities, and the security for those 11 facilities, regardless of whether the utilization rate is at 95% or 40%.
Precisely. The leverage works both ways. When the warehouses are full, the fixed costs are absorbed and the margins expand beautifully. But when broader logistics slowdowns occur and volume drops, those fixed costs immediately cannibalize the balance sheet.
It's a heavy burden.
A negative 2.67% gross margin tells us that they are currently suffering from severe underutilization. The sheer expense of maintaining 60 football fields of empty air is eating them alive while they wait for macroeconomic demand to catch up to their capacity.
And the market has ruthlessly priced in that margin bleed. Let's lay out the historical share performance for you. The one-year return is a staggering negative 82.6%.
The magnitude of that capital destruction cannot be understated, especially when you benchmark it against the broader market environment over the exact same period.
Right, because everything else was going up.
Yeah, this is not a situation where the entire logistics sector took a macro hit. Over that exact same trailing 12-month period, the U.S. transportation sector is up 8.3%, and the broader market, the S&P, is up roughly 17.5%.
So they are severely lagging behind both their direct peers and the macroeconomic tide. The market has isolated their specific execution failures, the negative margins, and the underutilization, and aggressively sold the equity down.
But the psychology surrounding that 82% drawdown is where the setup becomes uniquely compelling for active traders. You would assume that with negative gross margins and a chart that basically looks like a waterfall, the media and financial sentiment trackers would be overwhelmingly bearish.
You would think so. Yet the quantitative sentiment scoring for all top stories regarding the company remains completely neutral. The score is a flat 0.
Just 0.
Yeah. There is no explicit bullish tilt, but more importantly, there is absolutely no explicit bearish tilt in the media coverage anymore.
And a sentiment score of 0 after an 82% decline usually indicates total capitulation. The sellers are exhausted, and the negative narratives have been thoroughly exhausted as well.
Everyone who wanted to sell has sold.
Right. The market is fully aware of the negative 9.8% net margin. It is baked into the current valuation. When the bad news is entirely priced in, the equity becomes a coiled spring. It stops reacting to the historical margin bleed and becomes hypersensitive to any forward-looking catalyst or sudden momentum shift.
Which brings us directly to the technical momentum we are seeing right now. Because this is a low float name, meaning the actual number of shares available for public trading is highly restricted. On February 27th, so just yesterday, the stock was featured on a prominent list of 12 industrial stocks moving during the pre-market session.
Yeah, that caught a lot of eyes.
And we saw a similar spike on February 18th when they hit the intraday movers list.
Because when a low-float equity hits those momentum screeners, the mechanics of supply and demand violently take over. Algorithmic trading systems and momentum traders flood into a highly restricted supply of shares.
And the price just rips.
The price action can gap up incredibly fast, entirely disconnected from the negative fundamental margins we just analyzed. For anyone watching this space, you have to understand that the intraday volatility is currently being driven by structural market mechanics, not necessarily a sudden realization of value.
However, there are massive macroeconomic triggers unfolding here in 2026 that could provide the fundamental tailwind needed to actually justify that technical momentum.
Absolutely. We are currently navigating the final stages of the post-2025 supply chain normalization. The chaotic disruptions of the past few years have forced enterprise retailers to completely rethink their inventory staging.
Right.
At the same time, we are watching a massive sector rotation as capital rotates out of over-leveraged growth sectors and back into industrials and hard assets.
And both of these macro trends play directly into the U.S.-centric warehousing moat they've built. The push for nearshoring and onshoring means domestic enterprise clients require massive, reliable domestic footprints to stage their bulky goods.
They want the goods close to the customer.
Exactly. Suddenly, 3.5 million square feet of certified U.S. warehouse space free of debt looks like an incredibly strategic asset in the new global supply chain paradigm.
It does.
So for you listening and tracking this setup, the Catalyst calendar is very clear. Their fiscal year ends on June 30th.
The Q3 and Q4 earnings releases, which we can expect to hit the wire around May and June of 2026, will be the ultimate proving ground. The market will be forensically examining those reports to see if the ongoing e-commerce stabilization and that 0.8% top-line uptick can actually begin repairing the unit economics.
The narrative is essentially a high-stakes standoff at this point. On one side, you have a brilliant debt-free physical moat. 11 locations, a highly defensible niche in heavy goods, massive switching costs for their integrated clients, and the ultimate survival tool of zero leverage.
It's a strong foundation.
But on the other side, you have currently painful operational margins, the sheer unrelenting expense of keeping 3.5 million square feet of infrastructure running at low utilization, and a stock that has been battered into capitulation over the last 12 months.
It is the classic battle between the intrinsic value of physical infrastructure and the immediate reality of execution and fixed cost drag.
If a logistics company with zero debt and 3.5 million square feet of premium warehouse space can't squeeze out a positive profit margin today, is their proprietary OMS technology truly enough to flip the script when the next e-commerce boom hits?
Or perhaps we're looking at the wrong endgame entirely.
What do you mean?
Well, if their proprietary OMS is truly as revolutionary at managing the complex spatial requirements of heavy goods logistics as they claim, maybe the ultimate pivot isn't to be the biggest warehouse operator at all.
Okay, I'm listening.
If the fixed costs of the physical space continue to bleed them, the ultimate strategic play might be to license that OMS software to the very competitors who are currently beating them on margins.
Oh, wow.
Transitioning from an asset-heavy, low-margin logistics grinder into a highly scalable, high-margin software provider.
Now, that is the multi-million-dollar question, and that's the lowdown for today. Thank you for tuning in. The market moves fast, but the Easy Money Show is always here to simplify it for you. Make sure you subscribe and hit that like button before you go, and we will catch you on the next one.